Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us on the Nasdaq Market Site Desk, we have Steve Sosnick, chief strategist at Interactive Brokers, as well as Chris Dearborn and Max Cabasso, managing directors on Nasdaq's Market Intelligence Desk. They join me to discuss what is factoring into the more cautionary tone the market has taken over recent weeks. Gentlemen, it's great to see you as always. Welcome back to Trade Talks. And Steve, it feels as if the composure has shifted a bit for a number of factors.
Yeah, Jill, I think, it's interesting. I do think it coincided with the end of the quarter. I think we kind of had this last gasp run up into the quarter end. I think you had some positions being marked and the momentum was really solid. And, my thinking at the time was it was a really tough tape to fight, but it was time to get a little more defensive. And I do think that's been borne out a little bit. We still are up, a good amount for the year, depending on what index you're watching. But there's definitely a bit of a cautionary tone. It's definitely, let's think two-sided or perhaps glass half empty sometimes, and we'll see how that as the rest of earnings season transpires, how that goes.
Yeah, and Chris, I'm sure the inflation data that we've seen has been influential on the action that we've seen as well.
The markets had a fantastic run from the October lows to the end of the month, on the March. And then since then we're down anywhere from 5 to 7%, a little bit more. Some of the smaller caps are taking a hit. Obviously, that's where the inflation data is going to hit the most, especially on the repricing of the terminal rate, right? So those are the stocks that are getting hit the most. Something like 85% of the Russell 2000 is down now on an individual basis. If you take out the run you had from the end of Q4 and the beginning of Q1 into here right now, you're up almost 25%. They were pacing very well. The Russell Microcap was there. They've been cut in half, right? The S&P 500 and the larger caps are still buoyed by some of the better stocks there, and the Magnificent Seven, anything AI is still okay, but not great. But there's a lot of cautionary names out there too. You've got, we talked about this before, I'm going to harp on this again. When you look at, sticky inflation, you look at the retail sales telling me the consumer is out there doing well and spending. Right, unemployment's still pretty good at 3.8%. Wages are rising, people are spending. Yet when you listen to some of the issuers talk on their earnings calls and some of the discussions that we've had, they're very cautious and their stocks are taking haircuts. And some of those haircuts are significant. You're talking double digits on one day for some of the majors. It doesn't matter if it's beauty, if it's high end, if it's sporting goods, if it's across the board. So what are we really looking at here? If stocks are forward looking and data is looking backwards, where is the happy medium? And that's kind of where we are. To your point before, Steve, people are definitely taking profits coming into the beginning of the year. We talked before, you pick your name, doesn't make a difference whether you got rolling stops, you're breaking simple moving averages, you got to pay taxes, whatever the reason may be, that's where people are taking haircuts. Small caps have not had that luxury. They've been hit hard, and now they still need to raise capital because a lot of the capital that they have raised is very short term. And if we're looking at maybe one cut now because of the stickier inflation data, is that going to be a pre-election cut or is that going to be a December cut? If you're looking at two, is it going to be a September, December? Right now, it's a 50% chance of a hold for July, 30% chance of a cut in June. September is like a 50-50 number right now, but that's only because you're kicking the can down the road. I don't think the inflation data is sticky. The economy is doing well. People are spending. Wages are rising. The market is doing well, but something's not right. Like you said, there's a cautionary item here that you just can't put your finger on.
Well, let's take a look at a chart for a moment here. Max, we're going to have him pull up the 10-year. I think the velocity in the way rates have moved is something to take notice of. So.
Yeah, for sure. I mean, look, after we peaked at the end of 2023, late October, we really started to come off. 10-year was up at 5%. We got back down below 4% in basically 3 months. We had a huge move down, kind of calm, and now we're starting to pick back up. Obviously, with the inflation data that came out last week, we've ripped back through 4.5. Again, kind of bumping into some resistance here, though. If 4.5, if we test that again to the downside and that holds, wouldn't be surprised to see 5%. Look, those moves have been pretty drastic. You're not used to seeing moves like this in the Treasury market. On a constructive side, though, you see these moves and the reacceleration of rates. And stocks are still, again, looking at which index you're looking at. Russell, 2000 is a bit different than than the SPOOs, but it's been pretty constructive. Before the year, 6 months ago, the market was pricing in what, 6 cuts? And now we're essentially at none. You know, maybe one, there's a couple are close to 50%, but if you had kind of said that 6 months ago, where do you think the market's going to be if we have 6 cuts priced in and actually, wait a second, we might not get any? Would you think we're just off all-time highs in spiders? You probably wouldn't. Right? So again, taking some of the profits off the table, hey, okay, we're going to lock something in, maybe put some in some bonds here again, reallocating some money into bonds, lock in this 4.5%, 5% sort of rate or there, and see kind of how things go given the move we just had in stocks.
I mean, does 5% have to be the line in the sand, right? We're talking about an inverted yield curve forever. We haven't seen a recession yet.
Well, I mean, see, there's a few different points going on here. 5% is psychological. You know, it was psychological at the end of October, but it's interesting that 4% wasn't. We went from 5 to about 380, 370, something like that, in a lightning bolt. But now, over the course of the year, we've gone from, call it 380 to 450 on the 10 years. Meanwhile, in the 2 years, we did flirt with 5% the other day. And so, you know, it is a psychological round number. Part of it has to do with, because I've been thinking about this as well, like how were we able to rally so well as rate cuts were getting priced out and as bond yields rose. Now, a good economy causes bond yields to rise. So that's a good thing. You can actually have rising bond yields and rising stocks if it's premised upon a solid economy. If it's premised upon monetary accommodation, well, that's a bigger issue. Why do you need it? My prevailing theme at the beginning of the year, and I'm pretty sure we discussed this, was you can't have a year where you're going to have a solid economy that can allow you the type, you know, the 5 to 10% earnings growth that's priced in, and 6 or 7 rate cuts. They're both not going to happen. The stock market has been voting on the side of the stronger economy, and to some extent the bond market is too. That's okay. Although, as you're starting to say, Chris, you know, things are getting a little murkier out there, and I think now we're sort of, I hate to be the guy who uses the word stagflation because it's such a dirty word in most circles. It's, you know, it's right up there. You know, it should be banned like a 4-letter word in a lot of financial circles. But you know, I do think that sort of motif is out there. Are we going to have stubborn inflation and, you know, and a mediocre economy? That's a pretty bad sentiment. We are not there yet. But I do think the market is starting to think that maybe not all the rosy scenarios are going to come through the way we'd hoped.
I mean, you're seeing the nervousness in the market with the VIX, right? We just talked about before. You got a 19 handle. It's up over 20% in 1 week based on the inflation data, the strong economy, retail sales, you know, and then Fed commentary, right? I mean, that's definitely getting a lot more hawkish now across the board. You know, it'd be interesting if they pivot back and stay on the hawkish side, and instead of doing conversations about being accommodative, that they're going to start hiking. That would, what would that do to the market? What do you think?
Well, let's stay with the VIX conversation for a moment, because you and I have covered this a number of times. When you see VIX at very depressed levels, the moves to the upside, it's almost like taking not the stairs, but the elevator up.
VIX, you and I have, how many times have we had this exact discussion? But it's worth noting. VIX exactly takes the stair, where they say the market takes the stairs to the attic and the elevator to the basement. VIX does the opposite. It creaks lower, creeps down, and then it sort of hits a point where it's not logical for VIX to go too far down. You're not going to ever abolish volatility completely. But that means that people get complacent, and complacent people get nervous in a hurry. People who are a little bit wary, well, okay, you know, maybe I can withstand this. I'm not overinvested. You know, whatever. But if you've gone all in and you've said I have no need to hedge, I'm all set here. That's the people who freak out the most. And I'm not picking on any one person.
Well, Max, pull up the chart here, and we can see those exaggerated moves when you're at those low levels, such as, I mean, look at that. Where was it? At 12?
Yeah, we're very close. Here's 12, 13, sitting there. Another thing, might be anecdotal, but I had been seeing a lot more commentary about the short vol strategy coming back as a way to generate income. So anybody that's short vol, that's kind of why you take that elevator up. Everybody's shorting vol just to kind of generate that extra income. And then when it starts to go against you, it can go against you very quickly, and it can get nasty very quick. So what do? You get out of that trade, you cut that short vol position, and then maybe you put on some protection to the downside, say, I'm going to go long vol here because we're starting to move. So you're going to see those exaggerated moves. And again, when you're sitting at a 12, 13 handle for this long, any sort of gyration, I mean, we're at 18. right? It's not like we're at a, a 30 handle here. It's still, when you're looking back historical, 18 vol is not this crazy number, but because we're sitting it so low for so long, we're starting to see it move. And now, that's kind of why, we're back up.
I mean, you take notice on a percentage basis.
Yeah, right.
If I may, people feel much more confident about selling volatility when it's low than they do when it's high, which is, which is fine because you can eke out your pennies, but that's kind of the pennies in front of the train track strategy. At some point when you want to, the most profitable time to short volatility is the most difficult time. It's when you've got like a 30, 35 VIX and the curve is inverted in the front. Well, that's telling you that there's a real scarcity. That's where the real money is to be made. Now, that's a risky strategy in itself. I'm not, telling everybody to go do that necessarily. It's not for everybody who's risk tolerance. But it seems easier to do when VIX is like 14 and grinding down. Where are you going in? 13 and a half, 12 maybe? But when you go up, as you can see, you go from less than 2 weeks ago we had a 13 handle, and now we're to an 18 handle. That's a pretty rough place to be short.
It seems like that psychology also exists when you think about how people buy and sell stock as well. I mean, the inverse applies there.
Absolutely.
It's the same mentality, right? Why would you be shorting a penny stock? Where are you really going to go when there's so much other opportunity out there in the market? It's the same type of item. It's the risk reward and the limited downside, limited profitability to a really rough loss.
Well, back to what you were saying before, how we were able to hit all-time highs without getting any rate cuts.
Right.
Perhaps the market was looking at it as companies have operated quite well for the most part in a high interest rate environment. They have been able to adapt. Margins have been quite good. I would say for Q1, guidance is never going to be, something crazy. It's the beginning of the year. Right. There's not much visibility as there is perhaps when you're, in Q3 and looking to wrap up the year.
You priced in 6 rate cuts coming in. People are euphoric coming into the marketplace, right? And as we said before, stocks are forward-looking, right? You're buying forward multiples, not what they've done in the past. That's why if you look at what the banks just did, all the majors just reported they were pretty good to a lower bar, but all the numbers were good across the board. But you had a mixed skew of companies. A couple of them did very well, a couple of them did not. People are trading off of what their forecasts are going to be. Right now, the earnings roundup for the most part is the corporate earnings story is still intact, right? Nothing's really changed yet. The banks didn't give you anything to be nervous about. Actually, they gave you a couple of strong things. Investment banking was better, trading was better across the board. The majors had a good quarter. If that holds well for the others, and then you've had a couple of other incrementals coming through, right? Costco just came out with same-store sales, very, very good, right? Delta came out with earnings. Corporate travel is up on the rise according to them, right? Prices are expensive again. That's good. People are loosening the pocketbook there. Now we're going to start to move in some of the other sectors. You've got some of the big ones coming up, and a lot of Nasdaq 100 names coming up over the next week and a half, and we'll see how they're all doing. If you look at the price of some of the stocks, though, some of them have gotten beat up significantly. Is a good earnings quarter going to turn them around? But if you look at the price of stocks, I don't know. Some are at 52-week highs, others are at 52-week lows. And 2 of those are the Magnificent 7 companies. So you can figure out which ones they are. Well, it's going to be wait and see. It's going to be the have and have-nots.
So the upside, I think, is encouraging. Yesterday, when the minutes came out, you saw that initial dip, and it was bought back immediately. To me, that signals that, okay, this is now kind of priced in with what's happening with the Fed. With rate cuts, they're kind of out. And now we might be able to get into more of a stock-specific story with earnings coming in. The Fed's kind of in the background. Expectations are kind of wait and hold. If we see earnings and continue to be strong, I think we might be able to reaccelerate to the upside. Again, because the Fed now, we're not waiting for that backstop or that kind of boost anymore. That's now in the kind of rear view for a bit. These next 2-3 months. So I mean, look, those single names obviously were a bit top heavy in some of the indices, but if they start to perform again, and they show good earnings and they have decent guidance, again, it's not going to be crazy. We're in the first quarter. But you might be able to see a real tailwind there because the Fed is not such an overhang anymore. We've gotten those rate cut expectations kind of out the window, and we're still at kind of very close to all-time highs.
And Steve, to wrap up, I'm sorry, go ahead.
If I may, the other thing to keep in mind is, number one, it's always hard to bet against corporate America. Management is very clever. And the second part is, these rates are, we've all forgotten. We've all, the last 15 years plus, we've been in a zero interest rate, zero real interest rate, zero nominal rate, no inflation environment since the global financial crisis, but 5%-ish and 2%-ish, 5%-ish nominal rates and 2%-ish real rates are historically normal. Companies do know how to operate in that environment. We've gotten spoiled. It may provide a headwind for valuation. It's hard to sustain maybe some of the valuation metrics that we have based on that, but it doesn't mean the companies can't still make money in that environment. And that to me is very important. And that I think fits in with what both of you were saying.
Yep, and you read my mind, so you made my life easy. All right, guys, we're on time anyway. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.